Hi folks, welcome to the Smart Money Program. I'm your host Frank Corbin, and as promised, we're going to give you a wealth full of information for you to take action to change your financial situation. Today we have something totally different. I have Mike Scanlin from the company borntosell.com. Mike, how's it going?
Very good. Thanks for having me. How are you?
I'm doing excellent. So you create this amazing company called borntosell.com, and you guys have a subscription program where you guide people on how to do cover calls.
That's correct.
So to the average person, what is a cover call, Mike?
Sure. So a covered call is an investment strategy. It involves a two-part trade. The first part is you buy stock. You have to have at least 100 shares of pretty much any stock. And then you can sell a call option against that stock to generate income. And what a call option is a trade between two people where one person agrees to sell stock at a certain price by a certain date to the other person. And as the covered call investor, you are the seller of the call option. There is a person on the other side who is the buyer of the call option.
So this is actually kind of, if we can compare this, it's actually a contract. It's just a temporary contract to sell the stock and a temporary contract to buy.
That's correct.
So give me an example. How do I really make money doing call options?
Absolutely. Shall I switch to the slides?
Yeah, absolutely. So switch the slides. What Mike is going to switch the slides. He's actually going to show us a couple of examples of how the call option work, so you can get a clear picture of all this stuff. This is very new to most of us. The call option. I've been trading stocks for a while, and I've never done call options. But when I met Mike is going to educate myself, and I'm going to bring the same information to you guys so you can see how this call option stuff really works. Everybody knows trading stocks. They know day trading. They've never get access to a call option, which Mike is saying is less risky. Is that you buy and hold to profit, and also you have the option to sell a little bit above or trade above the norm to make some extra cash. So Mike, are we good to go?
We are. Can you see the slides?
I can see your slides.
Okay, very good. Yeah. So just briefly to review what I said earlier, that a covered call is a two-part trade. First, you buy some stock, and then you sell a call option against that stock. Right. And one call option controls 100 shares. So one thing to know off the top is if you have 100 shares of stock, you're only selling one call option, not 100 call options. And let's give an example, a real-world example. This was from this week. Let's imagine that on the start of this week, you had $7,455 of cash, which is what it would take to buy 100 shares of Netflix. If you purchase those 100 shares, you could then sell one call option with a strike price of 75 and an expiration date of next Friday.
Wait, hold on a second there, Mike. I want these folks to get this information really clear. So yes. I have $7,455. I use that to buy 100 shares of Netflix, and I sell one call option. So that means I'm selling the full 100 shares?
You're selling an option to someone else to buy the 100 shares at a price of 75.
So the contract is for them to buy the full 100 shares at the price at 75. So strike price actually means the price we're going to sell at, folks. Okay, is that we good?
That's right.
And we're going to expire May 19th. That's a week or so from now?
That's correct.
Okay, go ahead.
In exchange for that, the buyer of the call option will pay you today $3.25 a share, or $325 for the entire call option contract. So he's paying you $325 today, which you keep no matter what happens. What he's receiving in exchange for that $325 is the...
Hold on a second there, Mike. I want to slow you down a lot today because this stuff is exciting. So right off the bat, as soon as I put a call option to sell and the person do a call option to buy, the difference between what I own the stock at and what he's buying it at, I'm receiving $325 today.
Correct.
Wow. Continue.
Okay. So I just want to explain that what the buyer is purchasing for his $325 is the right to buy your stock at 75 at any time between today and next Friday. So if Netflix were to go way up, say it goes to 80, the buyer of the call option, the one that you sold it to, would pay you 75 for your stock. So you'd lose your 100 shares, but you would receive $75 a share in cash for your stock, plus the $325 you started with. And I'm going to have the next slide sort of works this out for you. So here's what could happen next Friday when this will all get resolved, because options do have short time frames and they expire.
Right.
So this was a total of a 12-day trade. So at the start of the 12 days, you bought 100 shares of Netflix. Then at the end of the 12 days, if Netflix was over $75, less than $75, you're going to keep your stock and you keep the $325 that you received.
Wow.
And at that point, the option has expired, and you are out from your obligation to potentially sell your shares. So you could sell another call option for the June cycle, the June option cycle. So
the reverse of this, the stock don't go up. It went back the opposite way. The stock decreased in price value. So what happens? I'm only losing just a little bit. Plus, I get the option to keep the $325 that the purchaser paid on contract.
That's right. And if the stock were to go down less than $325 a share during the 12 days, you would come out ahead, because the amount you received for the call option is more than the amount the stock went down. So on this slide, I show the adjusted basis is $71.30. That's your original purchase price minus the amount you received for the stock option, for the call option.
Right.
So if Netflix finishes above $71.30 next Friday, you've come out ahead.
Wow, this is exciting. Continue, Mike.
Sure. Yeah, I know it's very exciting, and that's why we created a company around it. So now let's imagine the other case where Netflix goes up. Let's say it finishes at anything north of 75 next Friday. It could be 78, it could be 81, whatever. If it's over 75, it doesn't matter, because you're going to lose your stock at a price of 75. The person who purchased your call option is going to exercise his right. He's going to pay you $75 a share in cash and take your 100 shares of stock. So what you end up with is the $7,500 he paid you plus the $325 he paid you at the beginning for the call option. So you have $78.25 in cash at next Friday if Netflix is over 75.
Nice. So let's assume Netflix goes up to about $80 per share. The buyer buy it at 75 from me, so he's looking at $5 per share profit.
Yes, minus the $325 he paid you for the option.
Excellent. Excellent. So my question is, why would a buyer want to buy the share from me? Why don't you just take his money and go buy his own shares?
Sure. Maybe he doesn't have $7,500 at the beginning to buy 100 shares. Maybe he only has $325. He can buy a call option instead. He's making a short-term directional bet. He's more of the gambler in this equation. The buyers of the call options are taking more risk because they're purchasing a security that has a short time frame, 12 days in this example. So he has 12 days for Netflix to go up. If Netflix stays flat or goes down, he loses, and the person who sold the option wins. Now, if Netflix goes way up, the purchaser of the call option might make 2 or 3 times his original investment. Depends how much Netflix goes up. And making 2 or 3 times your money in 12 days is very appealing. But the reality is that 75% of all options expire worthless. And so the statistics are on the side of the person who is selling the option, not the side of the person who is buying the option.
Excellent, folks. Again, you're watching the Smart Money Program. I'm Frank Corbin, your host. We're here with Mike Scanlin from borntosell.com. He's educating us on how we can do cover calls to leverage our retirement portfolio or even our investment portfolio to make yourself a lot of money. So, Mike, the question is, how much money I need to get started right away?
Sure. Can I put that question on hold for just 1 second and finish this example?
Absolutely. Continue. Yeah.
Sorry. I have one more slide here, and then I'll get rid of the slides. I just wanted to wrap up the example where you started with $74.55 in cash. If the stock was called away, you ended up with $78.25, which was on the previous slide. So you made $370 in 12 days. Well, that's not a huge amount of money, but over the amount that you invested, it is 5% in 12 days. Now, if you annualize that, so you take the 12 days into consideration, if you were to do that every day of the year, you'd make 152% a year, which is a very good rate of return if you could create this kind of a trade all year long. Now, on the other hand, if the stock was not called, if Netflix finished below $75 a share, you've lowered your basis by $3.25. So now your adjusted basis is $71.30, and you can sell another call for the June cycle. So I just wanted to wrap that up.
Absolutely.
I'm going to switch back to the video part here.
Folks, again, we're here with Mike Scanlin from borntosell.com. He's educating us on an amazing strategy, cover calls, on how we can make a lot of money or extend our existing portfolio to the next level. So Mike, brand new, starting off, how much money I need to get started?
Sure. With small accounts, it's difficult because of the commissions involved. So you want to be trading at a firm that has really low-cost commissions on the order of, $5 or $6 a trade. If you're trading at a full-service commissions, at $25 a trade, it's hard to make money with this strategy on small accounts because there are several transactions. You have to buy the stock, you have to sell the call, and if the call is exercised, there's usually a commission for the assignment of the shares as well. So there could be 3 commissions for one round-trip trade here. As a percentage basis, most covered call traders are targeting 1 to 2% per month. So that's 12 to 24% per year. So if you had $10,000 and you're making 1% a month, you're making $100 a month. If you have more than $10,000, you're making more. It's not a get-rich-quick strategy. It's very much like collecting interest. It's a game with patience, and you have to apply some time. If you can make 1% a month over 10 years, you're beating the market.
So would you say 5 to 10,000 is a good start? Excuse me.
Well, you can do it with that amount. You have to have enough to buy 100 shares. So it depends on what stock you're looking at. If you're looking at a $50 stock, 100 shares is 5,000. You can do that. If you want to buy 100 shares of Apple, you're going to need $56,000 because it's 560 a share.
Mm-hmm. So you trade this? You trade all day or full time?
I do. I mean, I run Born to Sell full time, but I'm passionate about this strategy, and all of my personal assets are in this strategy. I trade for my own account. I don't manage other people's money, but I basically built the tool that I wanted to use for my own trading.
So let me ask you a kind of a quick tip. What's the hottest stock on the market right now to do a cover call?
Well, Apple is my biggest holding. It has been for years. I'm a huge Apple fan. I think, with the new phone coming out this summer, potentially the TV coming out for Christmas this year, the thing trades at a low multiple relative to its growth rate. It's got a huge amount of cash on the books. They just announced this dividend. It's going to start paying out this year, which will allow new mutual funds that are dividend-oriented to buy it for the first time. I don't think you can go wrong buying Apple.
Even at the price it's at right now?
Well, it's expensive at $560 a share, or maybe $570 this morning, but you don't have to buy 100 shares. You have to buy 100 if you want to write call options against it, but even if you buy 10 shares, that's $5,700. I think it could be $700, next year. So
wow,
I'm a big fan.
So the cover call strategy, my question is, how come it's not known? How come a lot of people don't know about this stuff or doing it?
Yeah, well, it is actually reasonably well known, but a lot of investors don't take advantage of it. Call options have been around since 1973. Charles Schwab, the online broker, has said that of all their accounts that are enabled for option trading, 84% of them do trade covered calls. Now, not every account they have is an option account, but of those people who trade options, 4 out of 5 people do covered calls. It sounds complicated because, if you were to say exactly what you're doing, you are shorting a call option, and the concept of shorting confuses people, and the concept of options confuses people, but it really isn't that tricky. It's a really conservative strategy. It's one of the only strategies that brokers will allow you to do in an IRA account because, unlike some other option strategies which have unbounded liability, the covered calls don't. The worst that can happen is your stock is called away and you get cash. So brokerages will let you do it in retirement accounts. Everyone should be doing it. If you own shares and you're not selling covered calls against them, you're really leaving money on the table every month. You could be collecting an extra dividend every month on shares you already own.
No, I've heard stories that brokerage actually do unethical cover calls on people's existing stocks that are sitting there. Is there any truth to that?
I wouldn't know about that. I don't think that's really true. I mean, it's a pretty regulated industry. I'd be surprised if they were taking advantage of customer accounts that way. I mean, if they were, it's against the regulations.
Excellent. So if I have $5,000 to $10,000 plus, once I can buy 100 shares, I can get started. Now, again, folks, we're here with Mike Scanlin from borntosell.com. Borntosell.com. Mike, you've created a tool to help the average investor leverage a portfolio using cover call. What's that tool called and how does it work?
Sure. So that's borntosell.com is the URL and also the name of the tool and the company. And the name comes from you were born to sell options. So my customers are selling options to other people, which is what the name comes from. And the tool has two parts. The first part is a covered call screener. So it turns out there's 240,000 covered call choices when all the different combinations of stocks and expiration dates and strike prices. So how do you reduce this 240,000 things down to 5 that you might want to invest in, for diversification? You don't want to do just one. So the tool helps you do that. You set in parameters about the PE multiple, the industry sector, all these different filters of what you're personally comfortable with and looking for. And then it filters the 240,000 things down to a small set for you. The second part of the tool is a portfolio management piece where once you've put on 5 or 6 covered call trades, how do you monitor them? Because they're two-part trades. So normally in your brokerage account, it's tricky to put them together because your brokerage account will show you 100 shares of stock and then 1 short call option, but it doesn't really pair the two because they move together as underlying stock goes up and down. So we do that for you. We show you how much time premium is remaining. That's basically your income in every position you have. And so it helps you track your covered calls over time.
Excellent, excellent, excellent program, Mike. I like it. It's brand new to me. I'm pretty sure a lot of viewers also, and they can use this to make a lot of money in their portfolio. Now, your program bring just kind of funnel a few stocks that they can potentially buy or a company they can actually buy on a cover call.
That's right. Yeah, that's what the screener will do for you, is reduce the universe of possibilities down to a small set of things. Now, we're not a trade recommendation service, so once you've screened the set down to a small number, you still need to think, well, do I really like that company or not? I mean, if it's a small biotech that's about to have an FDA announcement or some earnings release, something volatile, probably want to stay away from it. So you have to do a little bit extra research just to look up important things like that. But otherwise, we are a huge time saver. We also have a free blog, a free tutorial, and a free newsletter on covered calls. So it's a great site to learn about the strategy.
Now, often when you find companies that that create these programs, these tools that teaches you or guide you towards making a lot of money, it's normally very, very expensive. What's the cost of your program?
Sure. So we're less than the profit of a single trade per month. So we charge $60 per month if you go month to month, or if you sign up for quarterly, it's $150 a quarter. So that's $50 a month. And if you go annually by 1 year at a time, it's $500 a year. So it's about $41 a month.
So pretty much if I make $300-400 per trade, I do 3-4 trades a month, I can pay your in fees within a couple of trades or less.
I have many customers who told me that they paid for their annual fee with 1 trade, and that makes me happy. My happy customers makes me happy.
So, okay, so let's go on the other side. So we're born to sell, or we're selling options, and let's go for the other side for folks who don't have the money to buy the stocks and sell it. So on the buying side, what's the advantage, the disadvantage, or what's the options I can do on the buying side?
Sure. So you can buy a call option the same way that my customers are selling call options. There has to be someone on the other side of the trade, obviously. The buyers of call options are people who think they know the direction the stock's going to move within a short period of time. It has to move in that direction before the expiration date of the option. Now, they can buy options that are longer dated, so you don't have to buy an option that expires in 12 days. You can buy an option that expires in 3 months. And so the buyer gives himself 3 months to be correct on the direction and the magnitude of the move. The problem is that for the buyer, that option is a 3-month option is very expensive. But maybe he doesn't have enough money to buy the underlying stock. Apple's a great example. It's a very expensive stock. You don't have $56,000 to buy 100 shares, but maybe you have $500 where you could buy 1 call option on Apple. And if Apple moves in your favor before the option expires, you could make 2 or 3 or 4 times your money in a short period of time. But as I said earlier, 75% of these call options expire worthless. So the buyer is wrong 3/4 of the time, and he's correct 25% of the time. And when he's correct, he might be correct in a big way. He might make multiples of his original investment. But I like the conservative strategy of having the statistics on my side. I'm right 75% of the time, and collecting income while I wait.
Very good. I like your strategy, Mike. You know what? I'm going to start doing some selling my call option soon, and see if I can duplicate your success.
Excellent.
Again, folks, we're here on the Smart Money Program. My name is Corbin, and your host. We have Mike Scanlin from borntosell.com. Now, how long borntosell.com been around?
We've been in business just over 3 years. And I've been trading covered calls for about 30 years. My father's a stockbroker. He taught me when I was 15 years old. And I've been doing this a long time. Even when I've had other jobs, I've traded covered calls on the side.
So you've been doing this from your teens?
Yeah, I have. A long time.
So are you ready to retire yet, Mike?
I enjoy I like for me, it's not work. It's fun. It's, making money. I enjoy talking to customers and spreading knowledge about covered calls. And I've done well. But, everybody always wants more, and I'm working towards that.
Now, does the cover call strategy have any impact on the market direction? Let's assume we're predicting the market is going to decline in the next 6 months ridiculously or increase within the next 6 months. Does that wide range of movements have any impact on a cover call strategy?
Well, if you think that the market's going to go down or the stock that you're looking at is going to go down, you would want to sell a call option with a lower strike price, maybe even a strike price below the current stock's price. So if the stock's at like $50 a share and you want to own the stock, but you think it's going to go down, well, if you think it's going to go down, you might want to just sell the stock. But imagine you didn't want to sell it for tax reasons or whatever. You own it at 50, you're worried about it going down, you could sell a strike price of 40. And it's 10 points in the money. So the first 10 points that stock drops, you're going to be insulated because of the call option that you sold. You'll lose on the stock, but you'll profit on the option, and you'll make more on the option than you lost on the stock. So you can still make money with covered calls, even if the stock goes down, as long as it doesn't go down by more than the amount you received for the call option. Now, if you think the market's going to go way up, or you think the stock's going to go way up, you can sell a strike price that's way out of the money. So again, if the $50 stock, maybe you sell a 60 strike, for 3 months out. Now, if the stock goes from 50 to 60 within 3 months, well, that's a 20% move in 3 months. If you get called away at 60, you still made 20% in 3 months, which is a great return. There is the downside that you're putting a cap on how much you can make, because you can't do better than the strike price you sell. So if there's a buyout and that $50 stock gets bought for $80 a share and you've written the 60 strike, you're only going to get 60 plus what you receive for the call premium. So in exchange for that cap on your upside, you get some downside protection and some current income. Excellent.
What's on the overall strategy? What's my major risk? What should, as a brand new investor using cover call, what's my major risk that I should look out for and be very careful with?
You have to pick the underlying security very carefully, because it is a long bias strategy. You are purchasing shares of the stock. So if the stock tanks, like if it's a Bear Stearns or a Lehman Brothers and it goes to zero, you can lose all your money. Any strategy that's long biased has that same characteristic. Covered calls are more conservative than buy and hold, which is the most popular strategy, where people just buy stock and they hold it and hope that it goes up. Because of the call premium that you're receiving, covered calls are more conservative than the buy and hold. But if you pick a loser, you could still lose. An example is last week, the Green Mountain Coffee Roasters went from $50 to $24 in 1 day. Wow. Well, if the stock is cut in half in a day, you're going to lose. And that's true with almost any investing. It's not you can still lose the covered calls, but you'll lose less than the buy and hold strategy, which is what most people use.
Okay, excellent. So if we follow your strategy, doing cover calls, what should the average investor be looking at to make on a yearly basis on his portfolio?
Yeah, so if you have it depends what's in your portfolio. If you have large capitalization, sort of blue chip, dividend-paying stocks, you've got Pepsi and AT&T and IBM, big names, pay dividends, you're probably getting 3% a year in dividends average already. By writing call options against those same stocks, you can probably add another 6 to 10% a year if you're writing out-of-the-money call options. So you add the 6 to 10% to the 3% dividends, and you're looking at 9 to 13% a year, which over enough time can make you wealthy. Now, if you want to be more aggressive, I have customers who buy stocks specifically for the purpose of writing calls against them, and they'll pick more volatile stocks because the call premiums are higher. They could make 2% a month, maybe. That's 24% a year. They may not make it every month, but 4 to 5 months, and then they'll have a loser, so maybe it averages out to 15% a year. But it isn't going to be double your money in 6 months. It's on the order of 15% a year.
Okay, so you can make more money, but you're not doubling it. It's not aggressively return or extreme aggressive return, but you make extra 15% a year, which is more than most portfolio normally generate. Is that true, Mike?
That's true. Yeah, the S&P 500, the market over a long period of time averages about 10%. So if you're a long-term investor, you're young, or you're investing your retirement money, if you can do better than 10% a year, you're beating the market. Okay,
but we talk about the brand new investors. Let's say we some existing investors who's doing cover calls already, watching the program. I want you to tell me, Mike, what's the smart money trade today?
Right now? Well, if they already have stocks and they're not doing covered calls, they should be writing calls against the stocks they already own, because they won't have to buy any new stocks, and there won't be any tax consequences for shifting their portfolios. If they just have cash, or if they're sitting on bonds, which are paying 2% interest, which is really hard to live on, I would recommend something that pays a dividend that is probably in the Dow 30. So let's take AT&T or IBM, something that is a blue chip. It pays a dividend, you buy 100 shares, you write a call option against it. It isn't going to make you rich quick, but you're unlikely to lose, and not losing is a really important characteristic of investing.
Mm-hmm. Now, I see you focus a lot on the big money stocks, the expensive stocks. Some investors say, why not do a penny stocks? Buy 100 shares of $1 stocks. Is there any risk to that, or is that a smart trade, or what?
Well, they don't trade call options on penny stocks, so you can't do covered calls with penny stocks. I think the minimum stock price is $5 a share. I think the lowest strike is probably $5. There's probably some stocks that trade $2 option prices, but they're large cap stocks that have a very low stock price. I can't recommend penny stocks, or in general, companies that have a very small market capitalization, as most penny stocks do. They're just too volatile. They're subject to market manipulation. Not a good strategy for conservative investing.
Okay, so what you say, Mike, is not overnight success, it's an overtime success. If you follow Mike's strategy, success is pretty much not guaranteed, but you make more than you normally make. Okay, Mike, how do they get hold of you?
I'm 46.
No, sorry. How do they get hold of your company?
Oh, I'm sorry. Sorry, I wonder, that's a little odd.
See, what Mike really means, that's 46, probably $46,000 you can make today, right?
So the website is the easiest way to get a hold of me. It lists all the methods, but we have, my email address is mike@borntosell.com. There's a phone number on the website, and happy to answer any questions on covered calls.
Excellent. Thank you, Mike.
Thank you.
Again, folks, you're watching the Smart Money program. My name is Corbin, and your host. We just listened to Mike Scanlin from borntosell.com teaching you your smart money trade using cover calls. Thanks again for watching. See you next time.